Finally on air. So thank you all for joining. I'm Nate Zeller, the Chief Investment Strategist with Secured Retirement, filling in for Joe Lucey today. Again, thanks for joining us. We're going to talk about our year-end investment strategy, kind of give our quick thoughts on the market, and primarily give all of you some things to be aware of and thinking about here as we come into the end of the year. Before we get started, I do want to give our legal disclaimers. Of course, keep the attorneys happy, but there's also merit to this. These are our opinions and subject to change without notice. All investing involves risk, including loss of principal, and there are no guarantees. I do also want to say that we will be talking about some market-specific activities today, and it's not to be construed as individual investment advice. If you do want individual investment advice, please give us a call and we'll discuss your individual situation. So I have 3 or 4 topics to cover. A couple of these first ones, for those of you that might have been on last week when Joe was giving the presentation, things to look at, these might be a little repetitive, but I think they're worth mentioning. First of all, with taxes, as you get to the end of the year, take a look at your individual tax situation to figure out where you're at, determine if it makes sense to tax loss harvest if you have a lot of gains this year, and with the stock market being pretty strong. Most likely do. And let me back up. This applies to taxable accounts. I know in most cases, we here at Secured Retirement work primarily with people in non-taxable accounts such as IRAs, but there are some taxable accounts. So this is worth mentioning. So if you are able to tax loss harvest, to do that. You may also want to realize gains for a couple of reasons. One, if you're aware of a large amount of income, maybe a windfall coming in next year, and it makes more sense to realize gains this year, you can do that by simply selling an asset. Then you could buy it back really the next day to reset the cost basis. Obviously, you'd be paying taxes on it, and that's one of the reasons why you might want to, is there's a lot going on in Congress right now, and we don't know where tax rates are going to be next year. And right now, they're at the lowest levels they've been in a very long time. So you might want to take advantage of that and actually realize gains this year, depending again on your tax situation. Another thing I want to throw out there is be aware of capital gains distributions, and this applies primarily to mutual funds and maybe to a lesser extent with ETFs. A lot of mutual funds pay out capital gains at the end of the year based on what they've been doing within the portfolios and their trading. This is an example of one, and this is MFS funds, which are fine. They're a great family mutual fund, certainly not trying to pick on them, and give them props for presenting the information that they do. I like how they give, the percentage, the capital gains estimates as percentage of the NAV net asset value versus a dollar amount. But they're looking at paying out 13 to 16%. And this fund that I have highlighted, a little hard to read maybe, but it's their core equity fund. They're looking at paying out 13 to 16% in total capital gains, of which about 10% is long-term and 5% short-term. So even if you've held the fund for longer than a year, you might subject yourself to short-term capital gains, which obviously are taxed at a higher rate. So depending on the situation, it's worth keeping a close eye on that, especially if you have mutual fund holdings. Like I mentioned, some ETFs pay out some too, generally not to such a large extent. The mid-cap, small-cap funds tend to pay out even more than large-cap funds. So it's just something to be aware of so you're not paying any extra to Uncle Sam. The next item to be aware of and pay attention to is your income. And this is especially important right now, given all the inflation, is you want your income to keep up with inflation. Going back the last 10 years, inflation's been pretty benign. So if your income stayed the same, it really hasn't mattered much. But now with the price of pretty much everything going up, I saw an article recently that healthcare costs are supposed to go up, or expected to go up. I mean, they already have, but it's supposed to go up even more next year. So make sure that your income is keeping pace. Make sure that you have an income plan in place. For those of you that your income plan consists of just drawing off of your investments, I would caution against that a little bit. We've seen some very good stock market returns the last few years, and if we don't see those next year and you're having to draw more off there, it could really have a very negative impact on your overall portfolio. And this is one that I think Joe's talked about the last couple of weeks, so we won't spend a lot of time on it, the income. But now moving on to more of the investment specific, this is a good time to evaluate your risk, your tolerance for volatility and loss. The market's been great, but there can be a lot of ups and downs. So make sure that you're comfortable with it. I kind of refer to this as the sleep at night. Do you worry about the market when it drops? Are you comfortable with it? And when you want to pair that up with your time horizon, we talk to a lot of people that are very aggressive and want to take a lot of risk in the market, yet they have a short time horizon. So it doesn't necessarily make sense because, if the market tends to drop when they need the money, then, they're really hurting themselves. And it works the other way too. We see people with a longer time horizon who maybe aren't comfortable with the ups and downs of the market, which is fine, but they could take a little more risk. So it's very important really to sit down. This is our retirement blueprint that we put together and determine what your income needs are, kind of the plan for the future where you see yourself in a few years to determine if you can maybe take a little more risk or maybe you shouldn't be taking quite as much as you are. But coming up on the end of the year, it's very important to evaluate this to see where you're at. In regards to investment strategy, so we have our long-term portfolio positioning, and this is how you position your portfolio over longer time periods. We're talking 5 to 7 years or so. And this is really the mix, your asset allocation mix, and getting back to your risk tolerance. Is your portfolio positioned in accordance with your risk tolerance? So after we evaluate that, take a look at it as a mix of assets, aligned with the risk that you're taking, and with the market doing as well as it has, especially over the last 18 months or so, it might be that positioning, your overall allocation, has gotten a little out of whack. Then besides that, you want to take a look at your tactical positioning, and that's more the short term, how you position your portfolio going out over the next few months to take advantage of what's going on in the market, any themes, capitalize on opportunities, and protect yourself against any downside risk. And so we're going to talk a little bit here now, so kind of spend the last half talking about our thoughts on the market, make a case for a bull market, as well as possible things we're looking at that could cause a bear market or a bit of a downturn. I'll just preface this by saying we're very bullish and optimistic on the market currently, but we get to the bear case, we'll talk about what we're looking at that might change our minds a little bit. So right now, we're seeing a very strong earnings are great. We've really just wrapped up our earnings season for the third quarter. Earnings have grown strongly over the past year or so. Profit margins for these companies continue to expand, which really is creating some real tailwinds for the market. With those stronger profit margins, a lot of companies have extra cash and they're utilizing that to buy back their own stock, which is good for shareholders. Gives you a greater share in the company if you do own the shares of the stock. We're also looking at strong inflows continuing in the market, for a lot of money coming into the stock market. And this is something right now, maybe you've seen this in the press. They call it TINA, and I'm not talking about some cousin of yours named Tina. It stands for there is no alternative. And when people are looking out at the investment landscape, at their options, they look at bonds not paying very much income or very low yields. We'll talk about bonds and fixed income here in a minute. They have to put the money somewhere, and it keeps going into the stock market. So that's just helping propel it higher and higher as more people continue to buy in. And if you think about this, a lot of people with 401ks just on a regular basis are putting money into the market, and that's helping to propel it upwards. We're also seeing easy monetary policy from the Fed. Interest rates remain very low. They're doing their bond purchases, what they've recently announced are going to taper and do less of going forward on a monthly basis and fully wrap up next year. But interest rates make it easy for companies to borrow money. It makes it easy for consumers to borrow money, make purchases, all this that helps move the economy along. There's also a lot of seasonality, and history doesn't always repeat itself. But if we look over the past several years, this time of year tends to be really good for the stock market. And one of the reasons why is with the holidays and consumer spending. And consumer spending is about 70% of GDP. So it's a very large portion, and it helps to propel the stock market at this time of year, and that doesn't necessarily mean it holds that way, but historically that's what's happened. And consumer spending does remain very strong at this point. We're interested to see what happens at the end of the year. There's some supply chain issues, so I was out shopping myself this weekend, just kind of looking around at a few places, and to me the shelves seem very well stocked and full. So if that continues, we would expect consumer spending to continue and help the market as well. Now the bear case for stocks, what might hurt it a little bit is obviously inflation. Last week we saw releases from the government that inflation's running at 5 or 6% per year. So that's rather high, and that certainly makes people concerned. Companies need to pass along their costs to people, which sometimes puts a dent in their profit margins because they're not able to pass along the full extent of the higher costs. And those higher costs are coming from, there's a lot of talk supply chain constraints. We've seen the ships, parked off the coast of California, waiting to be unloaded, and the truckers to bring them all those goods to where they need to be. We're seeing higher input costs from higher wages and higher costs of raw materials. So it's adding to the inflation. And then we expect to see rising interest rates. We talked about borrowing costs earlier too. So as interest rates go up, and right now they're sitting at still at historical low levels, so they have a lot of room to go. But at some point, people will be borrowing less. And if you think about it on an individual basis, like a mortgage, for example, right now mortgages are very cheap. I think mortgage rates are under 3% for a 30-year mortgage, or right around there anyhow. But if those interest rates creep up to say 4 or 5%, and then that, if you calculate out what your house payment would be per month, you wouldn't be able to afford as much. And so that's why rising interest rates could really put a bit of a crimp on the economy. We're also watching for possible missteps from the Federal Reserve. Right now, like we mentioned, the Fed is keeping a very easy monetary policy, but they're kind of behind the curve, so to speak, with interest rates, given the level of inflation. A lot of what's going on with the inflationary pressures, such as supply chain constraints, is out of their control. And so there's always the chance that next year they don't, right now they're calling for a couple of rate hikes next year, and maybe they raise rates too quickly, which would hurt the stock market, or maybe not fast enough, and we'd see even more inflation, or at least it would allow it to continue. We're also watching fiscal and tax policy, and this is a big one that should be circled, maybe highlighted. The infrastructure bill was passed in Congress. I think that was last week. Maybe it's been 2 weeks ago now. I don't know. Time travels so quickly in my mind, but I think a maybe bigger concern, and I hate to use the word concern, but that's what it is for investors, is the other social spending bill that's being talked about in Congress right now. I read this morning that the House is expected to vote on it here in the coming week, but won't be taken up in the Senate until next month. It's hard to say what will come from that. It's a lot of spending. We're talking trillions of dollars, and it needs to be paid for somehow. So how is the government going to raise the revenue to be able to pay for that? And there's been a lot of proposals for taxes on the table, then off the table, then back on the table. And they talk about the Roth conversions, for example. Like I mentioned earlier, tax rates are at an all-time low, so there's always a chance that taxes move higher. They've also talked about taxing corporations, which, not to get into the weeds too much, but a lot of that does get passed on to the workers and the consumers. So it ends up being a higher tax for all. And, depending on what comes out of that could, be a bit of a headwind for stocks. There's also the debt ceiling debate that needs to be resolved in December. So there's probably some market volatility associated with that. I still think that both parties will come to some sort of an agreement so the government doesn't default on their debt. But as they debate back and forth, it certainly could cause some market volatility. I did want to spend a couple minutes here, and this is getting into some of the nerdier stuff with some graphs. So if you're watching your computer, this hopefully makes some sense. For those of you listening, might be a little more difficult, but fixed income. So getting back to, the proper asset allocation for your investments, which is, the mix of investments. So you have your stocks, for example, that are in place to grow and hopefully increase your wealth. But you also want some fixed income, and people buy fixed income for a few reasons. One, for diversification. They want to really something to diversify against the stock market, and historically speaking, bonds have provided that. When stock prices go down, bond prices tend to go up because people move money into bonds. And that pushes yields lower, but yields are very low right now. And so, that diversification may not be there like it has been in the past. And one of the charts that we've been looking at is comparing the yield on treasury bonds versus the CPI, or measure of inflation. And if you're at the lunch and learn that I did a few weeks ago, I showed a similar chart. That was the 10-year treasury. This is the 5-year treasury, but it's really the same thing. And you can see that treasury bond yields have been very closely aligned with the rate of inflation until recently, when inflation's just taken off. And so if you're invested in a bond, you're losing money because the dollar that you have is worth less now than it was previously, and you're not earning enough interest to keep up with inflation. This also leads us to believe that bond yields probably will have to move higher in the coming months, if not a few years, to catch up. But this is a very big difference. The other thing that I want to show, so if you look at bonds, and again, we're really getting into the weeds here. So bond prices, and remember the relationship between prices and yields is inverse. It's like a teeter-totter. So as yields go up, bond prices go down, and vice versa. And right now, yields are very low. So if yields move higher, we would expect bond prices to fall. The other thing that affects bond prices is what we call a spread. And this applies to corporate bonds, any type of non-government bond. And the spread is the difference in yield between a corporate bond yield and a treasury yield. And as spreads, what we call widen, is they get wider, bonds do well, and then I apologize, bonds do poorly, their prices go down. And then as they tighten, their prices go up. But as you can see now, these spreads are very tight already. They're really at the lowest levels that they've been. And so we don't expect to see any, increase in bond values. And as a matter of fact, if we do see spreads widen, that would hurt bond prices. So overall, we're looking at fixed income right now that's not keeping up with inflation, and it's, you're losing money safely. Really, is what it comes down to, is that yield's just not keeping up. One thing I wanted to mention too, and again, this is really getting into the weeds for those of you that are looking at bonds or maybe own some bond mutual funds, is there's a measure called duration, which is a measure of the price sensitivity to change in interest rates, and it's quoted in years, which seems a little weird. So if you have a duration of 5, for example, it means that if there's a 1% increase in interest rates, your bond would lose 5% of its value, and vice versa. So if interest rates drop by 1%, we'd expect the value of the bond to go up by 5%. And it's a mathematical equation that it's really sort of a guess. So it's certainly not exact, but then you also have your yield. If you look, a lot of these bond funds right now have durations at 5 and 6, implying that their prices could go down 5 or 6% if yields go up by 1%, and their yields are at 2%. So the yield's not going to be enough to make up for that change in bond price. So we're looking at fixed income right now, and it probably isn't going to provide the income that it has in the past, probably not going to provide the diversification. So this is a great time to be looking at bond alternatives. There's a lot of options out there. If you're looking for income, there's other types of investments to look for, other asset classes that can provide income. If you're looking for diversification, and this is especially important in inflationary times, we haven't seen inflation like this in 30 plus years. So there's other asset classes to look at. If you're looking at diversification, there's hedged equity, for example. There's a lot of we deal with the buffered notes or the structured products, where it provides a buffer on the downside, but then caps the upside of the stock market, but it provides diversification. With equity. So if that's what you're looking for, or as well as, we have a lot of index products where there's a certain floor put in place, and then it's capped as far as the upside, but it is tied into the equity market. So you can still see modest returns, and it's providing diversification. I hate to get into these too much. I kind of equate it to myself, or if I'm at home fixing things around the house, I can paint a wall, I can do some minor electrical work, but the more complicated stuff, I need to call in a professional. Like if I'm rewiring the furnace or something, I'm not going to try that on my own. And that's a lot of these things are like that too. So if you do have an interest and want to get into specifics, please do give us a call to talk about those, or really anything regarding your portfolio, especially as we're coming into the end of the year. And that really concludes most of my talking points, what I wanted to discuss today. Did want to mention our upcoming event next week. We are doing a lunch and learn next Monday. We'll be discussing charitable gifting and here in Strategies. Plus, it's our Toys for Tots kickoff, or we call it Toys for Tacos, as we'll be serving tacos for lunch. You can bring unwrapped toy to us for Toys for Tots. We do have the drop-off bins here, so if you can't make it next Monday at any time, please do. And then we obviously deliver those off to the Marine Corps Reserve to distribute out to those in need. And then lastly, we're here. If you haven't had a year-end checkup or review, please give us a call. We're glad to do that at any time, discuss your individual situation, schedule one. We want to make sure that we do talk to you before end of the year, and it's approaching quickly, especially with the holidays, so it's good to get that on the calendars. Calendars are somewhat full. And so with that, I'll stop, pause, and see if there's any questions. And great question from Mr. Nordstrom. How concerned are we about stagflation? I'll be honest, that's a bigger concern now than it was, a few months ago. Stagflation really is a situation that we saw in the 70s, characterized by high inflation, really lingering inflation, and low economic activity, really no growth. And also in the 70s was characterized by high unemployment. We don't have the high unemployment right now. However, we obviously are seeing inflation, which the Fed was calling transitory. Now they've changed it and called it persistent, so it is lingering. We've seen it continue. So we expect to see that. We're really keeping a close eye on economic growth. It looks like it's slowing down. The economy's still growing. So we're positive there, but we see a lot of supply chain constraints, which could slow down manufacturing and have some ripple effects. So if we do see slower economic growth, we certainly could see a period of stagflation, similar, maybe not as bad as what we saw in the 70s, but similar. Odds now, I hate to put a number on it, but I'd say maybe 25%, and that's maybe the biggest risk that we're looking at going into next year is such an environment. Bank preferred stocks. Yeah, that's a great question. We don't really, especially in this environment, talk about real specifics, but bank preferred stocks, or generally it's the banks, financial institutions that issue the preferred stocks that pay a higher coupon. If you do look at those, a lot of those are paying. They have the higher rate. They're not necessarily keeping up with inflation. You have to be careful with those too. Some have a call date on those, so you could be buying it at a bit of a premium, receiving a higher rate, then get it called away at a lower price, and so your net return is less than what you think it is. But that is certainly something to look at as a possible fixed income alternative. There's also some risk if you go back to 2008. Obviously, that was a financial crisis, which we don't expect to see again. The preferred stocks maybe didn't fare quite as well, so I certainly wouldn't load up an entire portfolio full of them. But as part of a fixed income allocation, they certainly could make some sense, or as a diversifier to ordinary equities. Do we like inflation protected securities? We do. Again, similar to the bank preferreds, that seems to be a great alternative to, well, it is fixed income, but a great alternative to just what we call our standard fixed income, say corporate bonds and things of that nature, regular treasury bonds, because what happens, the interest rate stays the same, but your principal value, so if inflation goes higher, the principal value goes higher, so the interest increases then, in effect, causing a higher rate. Those are really good too for unanticipated inflation. So a lot of it's already been baked into the market, so to speak. But if inflation continues, those should fare well. And again, like the preferred stocks, it would makes sense to have those as a portion of the fixed income allocation in your account, but again, not maybe as the only part of that. What stocks and or bonds do you think are good for hedging? When it comes to bonds, it's fairly limited. Maybe some tips, inflation protected securities to a certain, again, in everything in moderation, of course. For stocks, so, if we're looking at inflation, it really depends on what happens. Our guess is inflation continues, and certain sectors tend to do better in inflationary times, such as energy, basic materials, real estate, for example. And real estate's another one of those asset classes that could be a fixed income alternative. I'd be very selective there, though. There's a lot of people that aren't going into the office, so office REITs, for example, maybe aren't the best place to be. But those having to do with housing or land purchasing could do better. And those tend to do well in inflationary environments. Also, allocations to things such as commodities, anything with raw materials, do a little bit better. I mentioned there's hedged equity strategies out there. Some of those can be somewhat expensive. We look at those from time to time, and there's other more complex investment strategies. I mentioned, we use the buffered notes, the ETF sometimes, but we can also buy those on an individual basis. And I think those are a very good hedge against what the market could do and help reduce volatility. All right. Any other questions real quick? Give it a last call. We're coming up on the end of the half an hour, and I apologize we started a couple minutes late, but want to thank everyone for their questions. Thank you for hopping on and participating. And as always, we're here if you have any questions. Don't hesitate to give anyone here at Security Retirement a call or myself. Again, my name is Nate Zeller. I'm the Chief Investment Strategist. But thank you all, and enjoy the rest of your week. And if you're here in the northern latitudes of Minnesota, try to stay warm as our temperature seems to have dropped a bit. So thank you and take care.